Well, hello. Welcome to Passive Wealth for High Tech Minds podcast. There are lots and lots of IT professionals who work in the industry. These IT jobs are so exhausting mentally, there isn't much time left for such folks to make clever decisions about their investments. Most are unable to put their money in the right asset classes. This is Prashant Kumar from My Realty Gains. I have worked in corporate America in IT and in business organizations for 25 years. My goal is to educate IT professionals like you about the benefits of passive investing. I will be passing my knowledge and will bring guests who have done very well in their careers and can explain the process and advantages of passive investing. So, let's begin. Well, hello. This is Prashant Kumar from My Realty Gains. Today, you are listening yet another podcast episode for Passive Wealth for High Tech Minds. Today, I have with me my great friend Stefan, and I can't even dare to pronounce his last name, but I know Stefan for a long time. Stefan, welcome to the show.
Thank you for having me, Prashant.
I am going to formally introduce Stefan, and then we will jump into question and answers. Stefan is the founder of RealtyQuant company, the company that brings data-driven and quantitative techniques to the real estate industry. He's on a mission to add industry value through education, investment, technology, and analytics. He's a financial engineer. He turned into multifamily investor, analytics speaker, and a live webinar host. He holds a master's degree in financial engineering from Columbia University. And during his finance career, he managed $90 billion worth of derivative portfolio jointly with his colleagues. He has been featured on multiple podcasts and webinars, events including Elevate, Best Ever Real Estate Show, Investing in US, etc. Stefan is from Bulgaria. He's the host of Finance Meets Real Estate webinar series. And he works very hard. He goes around and he talks to a lot of investors. I have talked to him many times on many webinars. Stefan, once again, welcome to the show.
Thank you for having me, Prashant. It's a real pleasure to be here.
Yeah, you bring great perspectives, Stefan. You have a great background, data-driven background. And we would not go too much into the technical details because the purpose of our show is to give value to a lot of high-tech minds who do not have time for themselves, who work 12, 15 hours a day at their job. And after that, they just want to get back home and then invest passively, potentially, like in stock market. Stock market is a passive investment. But there are real estate investments out there, which are much more lucrative than stock market. We wanted to understand, get your perspective. What do you say to these people?
Yeah. And I completely understand this perspective myself, coming as a finance professional before and having invested passively in various types of asset classes, right? And I want to say one thing I've done, at least at my company RealtyQuant, is some work on picking markets. So that is a very interesting question. And so what I want to say is at the current time of, let's say, people having concerns about the recession and so forth, I want to give a positive perspective of being able as passive investors to actually continue investing and do it comfortably and be, not, overly worried and so forth. And some of the approach to that revolves around downside risk. And I discussed that topic extensively before, including with you, Prashant. And so downside risk is really the concept there is, real estate is a fundamental asset. So real estate is, roughly speaking, so it's something comparative to if you have in the stock market, utilities companies or things like that, sort of value stocks or companies that are relatively easy to understand their future earnings and relatively easy to understand their pricing, in comparison to something like Tesla, let's say, just for high-tech people, Tesla is something very hard to value, where should the Tesla stock price be? But if we have something like the stock market in San Francisco or in Atlanta, Georgia, or in different markets across the US, it is, in my opinion, and that's something I've been trying to kind of influence others on is, in my opinion, relatively easy to understand where it should be valued, like based on its fundamentals of income, population, and housing supply. And so that then gives you once you know this, what they call market valuation, that then gives you perspective as a passive investor to actually pick markets where you know they're not overvalued. So where you're not comfortable, where under any market cycle that is impending, that is change of market cycle that could be happening, you would be comfortable that, okay, your real estate is not going to lose value, since real estate has a different downside risk profile than stocks. So we can get into that more, but it's really a different downside risk profile in the first place, such as it's stickier on the downside, so to say. And so whenever you're in like not overvalued markets, even if you have triggers, like some of the current triggers in terms of higher interest rates, reduction in future home sales, and so forth, those triggers, they do not adjust in pricing so much in the event of like under to fairly valued real estate. And so this is like some of the perspective. I can speak to like some markets that I think are good for that.
Yeah, we would like to hear your perspective, definitely. What I'm hearing you are saying is, because real estate is a fundamental market, right? Everybody needs a place to live. It's not like a volatile stock market. Location doesn't matter in the stock market, but in real estate, location matters a lot. And what I'm hearing from you is you are saying that, if you are in San Francisco or in Atlanta, every market has its different characteristics and you have different data points. And some of the global data points, like increase in interest rate, does not affect some markets, while it may affect other markets more, depending upon the strength of any individual market. Did I say it correctly?
Yes, and I would say dependent on not so much the upside strength of that market, as much as like where is it currently standing in its like valuation profile. Where so for example, like so if we have a market that's overvalued by 20%. Now, okay, obviously that has like some downside risk in the event interest rates go up, and in the event home sales reduce and so forth. If on the contrary you're in a market like many markets in the Midwest and Northeast right now, and let's say it's a market that's 5% undervalued, it's very statistically unlikely that that's gonna be the case. Even if interest rates increase, it's more like your prices are gonna stay the same. So that's kind of the dynamic that I've been seeing based on looking at the data, looking at the history, and that.
Good point. I think that's a very important point, that not all the markets can get the same variation in the home sale prices. I mean, it all depends on the strength, where the market is standing today. If the market is too high, then maybe there's a chance of larger delta. If market is at a very strong base, then the chance of the delta is very low.
Exactly, and exactly, and that's something that I do at my company RealtyQuant, actually, is providing market data for that. In the event, I'm not like pitching anything here, but in the event, like sort of like providing market data to sort of give an intuition for like different valuation in different markets and appreciation potential. Appreciation potential is another interesting thing. And that's also applicable to a passive investor, I would say, because if you think about how we pick markets right now, so we would look at, let's say, population growth, job growth, income growth, and all those different variables, fundamental variables, and we pick those variables, and then we say, okay, Charlotte, North Carolina is a great market because it's better in those variables than those other ones. But it's in itself, it's not a super data-driven approach like that, because you're kind of like taking like those few data points, and we don't look at it, let's say, across the US for like every single market or county and compare that well. And also the other thing is, so I did a study where I tried to forecast prices, appreciation, based on first forecasting those fundamentals, forecasting population growth, income growth, housing supply growth, and then off that to forecast the prices. And I found that I had like a 7% error. I had like that was like 5 times bigger than how they forecasted just prices themselves. And that's very interesting, I feel like, to a passive investor, because suppose that they're picking like a syndicator to invest in, they can go to, in different markets, let's say that they're working in different markets, and they can go to a market that, well, they can simply look at the price history of those markets, And chances are, and it kind of may sound like strange, but chances are they're going to do a better selection unless we're really early in the market cycle, like 2011, 2012, then they would need the fundamentals themselves. But if we're deeper into the market cycle, it's chances they would have predicted forecasted appreciation way better to perhaps a 5 times better error rate if you do it in an actual technical way by just pulling the prices, just like looking at, okay, how price performed well. If yes, then yeah, then it's like pretty high momentum. And just like looking at the price charts, basically, which is quite interesting. So it's really looking at the price charts themselves by doing a study like this gave like 5 times smaller error than looking at the fundamentals and then predicting the prices of that. So it's quite interesting. So that's one thing that I feel is like very useful, applicable, and it depends on the market. Some markets have more momentum. So markets in Florida and Texas, they have very high, well, I would say Florida and Massachusetts even, by the way, interestingly, they have very high momentum, like, and momentum can be tested in different ways, like autocorrelation is one, like what's the correlation this year versus last year prices. And so the autocorrelation there in Florida and Massachusetts is like close to nearing 80%, which is very high. So in markets like that, simply picking like whichever cities have performed very well and looking at historical prices, even though it's historical prices are not predictors of the future, but if you have autocorrelation, they are. And so that's kind of like the more accurate approach. I was actually able to forecast like 2018 and 2019 price appreciation by state, let's say, just as an example, within 1.4% error by based on 45-year history. So it's quite interesting. So it's actually very accurate. But when I went the route of population and income and housing supply, I had a 7% error, which is big. I mean, 7% is
a big.
Yeah, exactly. So it's a very interesting perspective. So if they want to pick like the best appreciating markets, if they went, let's say in Phoenix, Arizona, or those like very booming like Western markets like Phoenix and Austin and so forth, and how did been already the case that they appreciated, chances are that, in the past couple of years, chances are that trend is going to continue. Now, of course, that's dependent on, like, let's say if we were to have perhaps a recession or like other kind of triggers or a change in the market cycle, and then that could reverse. But under the same market cycle, like pretty strong momentum and like very much picking appreciation on that. That, by the way, holds even for overvalued markets. So even if they're overvalued, so the same appreciation predictors are the strongest ones. It's very interesting. It's just that simultaneously those markets then carry downside risk whenever the market cycle ends at some point in the future, let's say uncertain one.
Very nice explanation, Stefan. I mean, what you explained, and obviously it resonates to what you are doing right now. I mean, you are able to predict the markets to market, appreciation up to the level of 1.5% error based on 45 years worth of data, which is incredible. Is there a place where, do you ever publish any study or a paper where a lot of things what you are doing, a lot of us can learn, but obviously not everybody has time to learn. So people want to see, do you have a place where you can, if it is posted, can somebody review that data? Is that something?
Yes. Well, the data is, so it's at realtyquant.com. It's at my website. And actually, with the current quarters update of that data, I'm adding like all those forecasting, like appreciation forecasting as well. So yeah, so they would be able to see it there, realtyquant.com.
Got it. Okay. So basically, guys, you heard it, realtyquant.com, realtyquant.com. That's where Stefan publishes a lot of data. Again, from a passive investment standpoint, if you are a passive investor, you may want to just check out the place and see which markets you want to invest in, right? I mean, and then look for the operators, who are doing some business in those markets and potentially invest with them. But the purpose of today's webinar is to discuss about the benefits of passive investing. I know, Stefan, we were talking earlier, and you had some good points regarding depreciation and stuff like that. Do you want to elaborate on some of them?
Well, I mean, depreciation, yeah. So naturally, yes, real estate investing, as you Prashant know well, is like extremely tax efficient. As far as, generally, if you have, let's say, cash flow in terms of like cap rate to interest rate spread, call it, and then you have a given cash flow of a property, and you're able to generally erase like a lot of the let's say the tax that you would have on that cash flow, with depreciation. So that's a significant benefit. But then from there, it comes to like those various more advanced techniques like cost segregation and so forth. And now, yes, so it's definitely important for passive investors to look for sponsors who are perhaps doing cost segregation studies on their project. I'm actually doing a cost segregation study on a joint venture project I'm doing right now, and we just went on and we are doing like cost segregation study just to essentially, like have like significant deduction on our taxes like the same year. So that's, that applies, like has like a bigger, like even bigger impact on like real estate professional status and so forth. But overall, like I would say it's very important to not only speak to your CPA, but speak to like more advanced tax professionals, like, even like Brett Swartz and people like that who do like even deferred sales trust is a great benefit for passive investors that applies to real estate, it applies to stocks, it applies to cryptocurrencies in the event you have a big enough position that you want to sell. That's something I actually recommended to a friend of mine who works at Google, where, one can do a DST even on a stock sale, that is, let's say, of a significant value. So that is, so those are like very big tax benefits. Now from there, like I would say those are some that apply to more the passive side. And I wanted to briefly mention, Prashant, actually on what I think like people should, which markets maybe people should invest in when they pick sponsors to it, if that's okay.
We have all the years. That's why you are here for, Stefan.
Absolutely, yeah. Yeah, so it's very interesting right now, like, because like people are concerned about the recession, so it's very interesting. So the one interesting thing is if we take like the big picture across countries, so there is the thing that is called the scans economies. So the scans economies, those are they're small open economies that are commodity exporters that have independent central banks, where their central banks cut interest rates during the 2014-2016 commodity crunch. Those are Sweden, Canada, Australia, Norway, and New Zealand. So those countries, they're like in very different geographies, but they share those same components, and they happen to have very overvalued real estate. So that's like, to some, like I did a podcast in Canada actually, and like people there are really concerned, like Canada real estate is very expensive, right? And as some of you may have heard, and so all those countries, they do share this trait of having very overvalued real estate compared to their fundamentals. It's a function of central bank policies of cutting rates very well. So they're like very much, I would say, comparatively at risk in the event of like other like macroeconomic drivers changing right now, such as the yield curve inversion that happened and consumer sentiment dropping, sort of this kind of recession triggers. Now, recession is not always paired with real estate drop, by the way, just can't calm people down. In fact, most of the times it's not. Like more often there's no real estate drop during a recession, but it's still like an interesting consideration. So the scans economies is one thing to watch. So Canada and Australia and so forth. Now in the US, which are like some of the markets that are more at risk. So the first one to watch, and I've spoken on this about before, is Idaho. So Idaho is, in multiple sources between Florida Atlantic University, Moody's Analytics study, my own study that I have at RealtyQuant, and perhaps the fourth one, I'm not remembering the name, the most overvalued city in the US, this market cycle, is Boise in Idaho. And that's like based on fundamentals of income, usually only income, but my study is income, population, housing supply.
Yeah.
And so Idaho is one market to be a little bit cautious about, I would say. And then like some Western markets, some states like Nevada and Arizona and Utah are a little bit have moved also higher. And there's like some increased valuations with inflation in Florida and Texas, not to super concerning levels, but relatively speaking. But then investing in the Midwest broadly is very fairly valued. So states like Indiana and Ohio and Kentucky are still fairly valued. And then the Northeast, where, okay, it's not so desirable due to various policies for the different sponsors of real estate. But the Northeast is generally undervalued right now, in terms of, so very low downside risk. And so, that's like an interesting perspective. So more cautious in terms of a recession in places like Boise, Austin, Phoenix, some of the very booming markets. They will continue booming a lot, perhaps while we're in the same market cycle due to momentum, that's, as I mentioned earlier, but more cautious on the downside risk. And then much less in places like Louisville, Kentucky, and in Indianapolis, I guess even like Pittsburgh, and like markets like that in the Midwest and Northeast. I would not be too concerned there. I actually I had a meeting with this private equity fund, and they adjusted their strategy to invest in ahead of like the prospects of a recession, to invest in only secondary and tertiary Midwest markets. And I thought it was very interesting because it's actually, okay, Midwest is fairly valuable. That's actually quite safe. If you're even in secondary and tertiary Midwest, you're going to be fine this market.
Yeah.
So to passive investors, like that's kind of my advice to, okay, I mean, depend on your risk tolerance. Like you can still invest in Phoenix. It's appreciating, like projects have made a fortune in Phoenix right now, right? So it's appreciating a lot, but just to be aware of like the simultaneous downside risk you have there. So just kind of based on your risk tolerance. Now you need to have the exact data, obviously. And like I said, RealtyQuant.com is one place for that. And you can look up you can look up some more general studies with Bloomberg Economics, Moody's Analytics, and other like bigger companies. But yes, just being aware of market valuation and being aware of downside risk in some of those Western and a little bit Southern markets. So that's the current situation. Like if you're in California, let's say, and you want to invest in California or buy a house in California or invest in a syndication in California, well, it's actually fairly valued right now. If you're investing in San Francisco, it's undervalued. Now that's due to its weak fundamentals as well, right? Because there's like all the issues with COVID, and it went deeper undervalued with COVID. But in a way, assuming like, unless it drops on the fundamentals themselves, which is possible, that actually happened in San Francisco, dropping on the access to fundamentals is not likely there. And so it's kind of, it's an interesting perspective where, okay, people left California to invest in Nevada because it's cheap, but then now Nevada is expensive on relative terms, and California is fairly valued on relative terms. So it's quite interesting. So California may be more expensive in absolute terms, but in relative, it's actually fairly valued, and Nevada is expensive in relative. And so that's kind of like the consideration, I think, when picking a market, that like some of the very trendy, very booming markets, I would perhaps stay away in the event of considering like yield curve inversion and that, and just kind of perhaps invest with sponsors who are more inclined to, like I mentioned, like markets like Louisville, Kentucky, Indianapolis, and places like that.
Awesome, Stefan. I think you kind of hit the nail on the head, saying, giving the advice to the investors, that probably remain away from the momentum markets, the markets which have had so much growth in last couple of years, Phoenix, be Austin, or potentially some of the other places like Nevada and all that, because we have had so much growth there. And I mean, their bases are, their variables for the base are not so strong if the cycle changes the direction. So there are chances of them going down probably would be more compared to the markets which are more stable, like Midwest, secondary to tertiary market, the equity firm that they are even willing to invest into tertiary Midwest markets, which is kind of surprising to me. But I think it's a good strategy that people want to hedge their bets for the future, where investors may want to at least get the cash flow and not lose the value of their investments at the same time. You are getting the cash flow. If you are in a secondary or tertiary Midwest market, you get 7, 8, 9% return on the money, and your value of the asset holds. Maybe it goes down, a couple of points here and there, but you still hold the value. So
Exactly.
these are the good points for at least next couple of years. That I think that's what you are proposing. And by the way, what you are proposing is not based on your hunch. It is based on the data that you have derived. All these things
Correct.
are being derived from the data approach that you have.
Correct, correct, and it doesn't always. And to your point, it's not just based on hunch, indeed, because it's not in this case at all, right? Because actually it could divert from your intuition in some case. So let's say if we look at before GFC, before global financial crisis, New Jersey, let's say, was actually overvalued to some extent, like over 20%, and it had a decline of like around like 20-25% in the state of New Jersey, and let's say that's not a market that right now we would imagine it's desired, right? It's like the least desired real estate investment market. And so, or it's not a market, it's a state, but like, let's say the various markets within it. And so it's, but it was actually at that time, at least, with the, the excessive lending and so forth, was actually overvalued. It just doesn't happen to be the case now. Now, if we take the Midwest and the Northeast or California, and they're not, if you actually go on computing market valuations, it's actually they're not overvalued. And so so that's kind of the situation, but it doesn't always align with intuition. Had we been a little bit earlier in the market cycle, let's say to the beginning of 2020, even Utah was fairly valued. It's actually great timing to invest then.
Yeah.
Even beginning of 2020. Or Denver, Colorado. Denver, Colorado was a top 5 performing city, and it was right at 0% at the beginning of COVID in market valuation. It was like fairly valued. So that's, again, like it depends. Yeah, it depends where we're in the market cycle. It appears we're relatively forward. Now, it's always hard to say like what timing, like how far out we are. But yes, from a capital preservation standpoint, I would probably stay away from like, well, I would say 6 Western states a little bit. Like, the 6 states of Washington, Idaho, Arizona, Nevada, Utah, Washington, and I think I'm forgetting the 6th one right now. But and Colorado, I guess. Did I mention Colorado? Yeah. So that's so that is kind of the perspective, and predominantly Idaho, I think, is like the biggest risk. So other than that, in most other places, even in southern markets, if you're, let's say, with a sponsor who is in Louisiana or in Alabama, or, that's relatively okay. Even Georgia is relatively okay. Even Georgia and the Carolinas are not so bad. It's just in comparison to, let's say, the Western state. Even if you're in like Atlanta, Georgia or something, it's also relatively okay. But they're really like capital preservation. That's more like going to the Midwest, and then the real capital preservation would probably close to no appreciation, though. On the other hand, would be if you go to the Northeast. So that's kind of there's definitely a counter correlation between appreciation and at the current moment, how big is your downside risk, considering how far out we are already, almost 12 years into this market cycle. So
wow, great nuggets, Stefan. I mean, Stefan comes from Bulgaria. He's tech head, too much technology, and he has built this company RealtyQuant. Definitely, check it out, guys. And he has given us the nuggets over the next couple of years. When passive investors, you have listened, passive investors are willing to invest anywhere they want, right? But at the same time, there is some due diligence that is needed, and it's a very timely advice. Those who are coming into the market right now, they should potentially look for operators who are not investing in Nevada or Idaho or in Colorado or California or Washington, these states. I mean, potentially go for Midwest states. If you go too much into, I mean, Georgia is still okay, as he said. South Carolina, North Carolina, they are still okay. Stefan, besides RealtyQuant, what else do you do? I mean, just tell us a little bit more, because we will have only a few more minutes left for this recording.
Yes, of course. I mean, I'm an investor myself in the ground. Mostly I do like projects around the New York City area. And I've been working at like out of state commercial multifamily syndications in the Midwest right now. So this is what I do. I'm an investor. I write like different other analytics on the property side also is something that I do. So I write like maybe like some algorithms and things. I try to do like modeling on the property side. So that's what I do now. In my previous career, I was a financial engineer. So I used to trade derivatives for an insurance company. That was my job. So.
Okay. No, very good. Okay. I mean, hopefully, you are making out better now. I mean, you are not working full time, and I mean, same am I. I am also. I mean, I'm not working full time. I'm just doing real estate only. Although it used to be on the side, but I'm full time in real estate, and you know, Stefan has given us so many golden nuggets, folks. You have already heard a lot of benefits of passive investing, but today he talked about, even while doing the passive investing, how to pick markets, how to remain away from momentum markets. So that's a great insight. And you all know where to find Stefan. I mean, basically realtyquant.com. Any final things, Stefan, you want to tell our listeners?
No, I think that was great. Thanks, Prashant.
Okay. And what, I mean, you want to share your contact information besides your website?
Yes. So besides my website, I can be found on LinkedIn, and I also have a YouTube channel, Finance Meets Real Estate, on YouTube.
Awesome. Finance Meets Real Estate on YouTube is the Stefan's channel. By the way, I've been following Stefan. I mean, I know him for a couple of years now. We have talked many times, and we tried to become business partners, still in the play. But overall, Stefan, thank you so much for your time. And hopefully our listeners will get something out of this episode, and I'm sure some of them may contact you if needed. Stefan, thanks again. Thank you so much for listening to our podcast. As usual, you can reach me via my website, www.myrealtygains.com, and via email, prashant@myrealtygains.com. I would love to hear from you and talk to you about specific needs you may have. Please schedule an appointment with me via my website, again, www.myrealtygains.com. Stay tuned for next podcast. This is Prashant Kumar signing off for today.